Hi students, in this video we are going to see another mergers and acquisitions question which commonly the students find it a little bit difficult. So as usual, first we will have a look at the requirement. Look here, the first part. Discuss possible sources of financial synergy arising from current company's acquisition of Danton Company. More or less a straightforward question it is, because we know sources of revenue synergy, cost synergy, financial synergy. Here the question is only about the financial synergy. So if we can somehow map the theory that we studied about financial synergy into the scenario, you will get that 4 mark, not that hard. Advise the directors on suitable share for share exchange offer which meets the criteria specified by Danton Company shareholders, and calculate the effect of the cash and share for share offers on the post acquisition wealth of both Kirin companies and Danton Company shareholders. Seems like there are many requirements within it. We will read the question and we'll come back to that. Mostly all calculations, that 12 mark is. Discuss the likely reaction of Kirin companies and Danton Company shareholders to the cash and share for share offers. So that part mainly we have to see how much of gain Kirin company shareholders get and Danton Company shareholders get. And then there are other points to discuss. Cash offer, it gives you the immediate liquidity, certainty. Share offer, there is an uncertainty. So we'll discuss all that. 4 marks for that at the end. We will read through the question. A new client has approached you for advice on a potential acquisition. Kirin Company is a consumer electronics manufacturer and retailer. The company obtained a listing 8 years ago with the founders retaining 20% stake in the business. Whilst Kirin Company had previously experienced rapid growth in earnings before tax, problems arose soon after the listing as competition intensified. Although the company remains profitable, annual growth has declined significantly and is currently 3%. The board is concerned by the lack of future growth opportunities. The current share price reflects these concerns, trading well below the offer price of 8 years ago. In response, the directors have decided to invest in a market development strategy for future growth, utilizing significant cash reserves to acquire companies in other areas of the country where competition is less intense. Board has identified potential target Danton Company. So basically that is a common background for an acquisition question. There is a large company which has been profitable in the past, but now they are struggling to maintain the profitability. So they are thinking of taking over a company to keep up their profitability. Danton Company. Danton Company is a privately owned consumer electronics company. So it's in the same field, is it? Consumer electronics, yes. Established 10 years ago, significant unrelieved losses were incurred in the early years of development, although the company is now profitable and achieving growth in earnings before tax of 6% per year. However, cash reserves are low. Access to capital has acted as a severe constraint on Danton Company's reinvestment potential throughout this period. Of course, it's a private company. They will have limitations in raising finance. The founders and their families own 60% of shares, with the balance held by venture capitalist organization which acquired its equity around 6 years ago. Okay. Usually venture capitalists around 5 years, 3 to 5 years after the investment, they try to exit the investment. So here they have gone to 6 years, means either there was a lot of struggle at the beginning, now only it's coming to a better position. Possibly now only the venture capitalist also looking for an exit. Acquisition information. Kering Company's board is keen to ensure that Danton Company's founders remain as directors after the acquisition and the company has sufficient cash reserves to purchase Danton Company outright. Look, if you want Danton Company's founders to remain as directors, one option, give them a share for share offer and keep them as shareholders and directors. If not, give cash offer so that they don't remain as shareholders anymore in the combined company. Then you have to appoint them. They will become appointed directors. Okay, let's see. Early discussions between the directors of both companies suggest Danton Company shareholders would approve a cash offer of $13.1 per share. As an alternative, the board is considering a share for share exchange to fund the acquisition in order to preserve the cash for future acquisitions and dividend payments. Recent mergers have attracted an acquisition premium of 25 to 30%, and Danton Company's directors indicated their shareholders would be expecting a premium towards the higher end of this scale. That means around 30% premium they are expecting for a share for share offer. Kering Company has therefore asked you to design a share for share offer scheme which will allow for a 30% acquisition premium. You have been provided with extracts from the latest financial statements for both companies. Extracts from the most recent financial statements, Kering and Danton, operating profit, earnings before tax. Additional financial information. The book value of Kering Company is $0.5. Ordinary shares is 375 million. These shares are currently trading at 5.28, and the finance director expects the price earnings ratio to increase by 10% if the acquisition proceeds. Danton Company upgraded its main manufacturing facility during the previous year and expects to make annual pre-tax cost savings of 2.5 million from the start of the current financial year. The book value of Danton Company is 0.25 ordinary shares, $35 million. Based on an analysis of companies of a comparable size and cost structure, it is estimated that Danton Company's PE ratio is 20% higher than Kering Company's PE ratio. Usually that is not the case. Private companies usually have lower PE ratio than the public companies. But in this case, the public company, Kering, is in trouble. They are not making sufficient profits. Because of that, the prices have gone down. So, it's a special case. They have a lower PE ratio. Possibly that is the reason why the private company has a higher PE ratio. Kering Company's Chief Executive Officer estimates annual pre-tax revenue and cost synergies of 15.2 million to arise as a result of the acquisition. In addition, the finance director anticipates annual pre-tax financial synergies of 5.3 million. So, revenue and cost synergies of 15.2 million, financial synergies of 5.3 million. Corporate tax is 20%. Discuss the possible sources of financial synergy arising from Kering Company's acquisition of Danton Company. So, first of all, the synergies we have. The synergy we have that comes from three areas. What are the three areas? Revenue synergy, cost synergy, financial synergies. Revenue synergy means, first of all, what is synergy? One company acquires another company when they become combined company. Suppose if this makes 10 million revenue, this makes 10 million revenue, combined company makes more than 20 million, say 22 million. Then extra 2 million is synergy benefit. So, revenue synergy means the overall organizations, that means the combined entities revenue is bigger than the sum of individual revenues. Why that might arise? We know the reasons. You become stronger in the market, so your competitiveness would have increased. Likewise, we studied several benefits, several reasons for this. Similarly, we have cost synergies. If this had a cost of 5, if this had a cost of 5, if we just add up 10 million, but the combined entity might have lower than that. Why lower? Certain departments, if you think the work is going to be duplicated, you can make certain people redundant. Because of the economies of scale, you may get discounts from your suppliers. So bulk purchase discounts, you call it. Yes. So we know the reasons for it. But that is not what they are asking. They are asking about financial synergy. What is financial synergy? That means there are certain other benefits that the company might get because of the combination. Funding side benefits. What is that? See, they say one company, in this question, Kerin company has cash reserves. Danton company, even though they are profitable, the business is going well, they couldn't attract fund. Because of that, their growth was limited. Now, if you combine these two, Kerin company's excess cash reserves can be used as funding for Danton company, and Danton company's growth can be driven by that funding. This is one of the financial benefits, right? One company has reserves, the other company has shortages in funding. Now, if the business combination takes place, they can help each other and drive the growth. That is one. Funding. 2, remember when I was reading about Danton company, they said they had situations where unrelieved tax losses was there. What is tax losses? When you calculate taxable profit, it is not a plus, it's a minus figure. It's a loss. So what we usually do, we carry it forward to the next few years. Suppose if the loss is too big, because carrying forward might be limited to a certain number of years, 2 years, 3 years you can carry forward. So before that, if you made huge losses, you may not be able to carry it forward. So after the business combination, when you look at it as a whole company, suppose if this made loss, whereas parent made profit, you can set it off. Loss can be set it off against the profit of the parent company if it is allowed in the tax regime. Then your tax reliefs can be obtained. Tax relief. This is another benefit. We call it financial synergy. When the companies are combined, you can get it. In this case, when I was reading about Danton company, they said that there are unrelieved tax losses. Third one, this is in one region, this is in another region. They say this is Danton company is in some other geographical areas. So when you are spreading your branches, when you are expanding, that can reduce the risk of cash flows, or the fluctuations or vulnerability of cash flows can be reduced. When you have many branches geographically diversified, then if one area gets a hit, doesn't necessarily mean the other area is going to get a hit. So your cash flows become more stable. Risk of cash flow or stability of cash flow improves. What is the benefit of that? Because of that, now you may be able to attract more loans. Because of this, because banks or lenders, they look at the stability of cash flow. That is one important factor when any lender decides how much to lend, how long to lend. So here, having many branches geographically diversified gives some stability to the cash flow, so you can get more loans, more debt. Debt has some advantages. What is that? Tax shield. When you take more and more loan, you pay more and more interest. That gives you tax benefits. Tax shield is going to be there. This is one of the financial synergies. Fourth one, because of this risk reduction, your cost of capital might reduce. So that brings down the risk of the company, and then that cost of capital reduces. So if cost of capital reduces, the value of the company will increase. That's another benefit. So the question is about 4 marks, isn't it? That's for how many marks? 4 marks. So take 2 or 3 points. 3 points explain very well. That should give you that 4 marks. Part B. Advise the directors on suitable share for share exchange. So how do we like usually they give share offer 1 for 2 shares, 2 for 3 shares, likewise they give it. This time they are asking us to design the share for share exchange. This is what the students might have found it difficult in this exam session. They don't know how to, or they didn't practice how to design the share for share exchange. I'll show you, don't worry. First step, what we do, let's do the valuation of companies. You know, we have Kerin company, then we have Danton company, then we have combined company. So this is V1, the equity value of Kerin, let me say V1, that is my usual notation. Target company V2, combined company I used to say V3. Let's find these three, because there is this point I always emphasize in the mergers question. Value created by the acquisition V3 minus V1 and V2. So this is the overall value, synergy created by the acquisition. And this value creation is what we are going to split, what we are going to share it among K's shareholders as well as D's shareholders. So here D shareholders has a demand, they say we want this much premium. So that premium has to go from this value. So if premium goes as X amount to this premium on acquisition, then I can find how much balance is going to be there from this total value created after giving the premium. How much balance is there? That is what goes to the acquiring company shareholders. Once again, this is the value created by the acquisition. From that we can find how much of premium we are going to pay. This is the value. Premium we pay is the value for target's shareholders. That's the additional value for target shareholders. Then you find the remaining amount. What's the meaning of remaining? Out of the value created here, after giving premium, how much of remaining is there? This remaining is the value for acquirers shareholders. So as the first step, let me find this V1, V2, V3. Easy. V1, V2 was straight away given, I remember. Look here, book value this, and market value is this. This is for which company? Kerin company. Okay. So let me say Kerin company's equity value. That's what I mark it as V1. $375 is the book value, 0.5 is per share value. Divided, you get the number of shares, 375 divided by 0.5. Then multiply by share price 5.28. 5.28. Kerin company's equity value. This is V1. Then how about the other company? Other company, they have given some PE ratio, 20% PE ratio, higher than Kerin company's PE ratio. Let's find Kerin's PE ratio. Kerin's earning before tax is given 381.9. This is from the most recent financial statement. That means last year. These shares are currently okay. So let's find, this is earning before tax. Let's find earning after tax. Tax rate 20%, 381.9. Future earnings per year, 381.9 multiplied by 1 minus 20 percentage. Why 1 minus 20 percentage? Tax is 20 percentage. Subtract that so I can find the post tax. Right. So PE ratio, let's divide it, this divided by this. 12.96151. Let me round it to 2 decimals. This is Kerin Company's PE ratio. So Danton Company's PE ratio, question says it will be 20% higher than this, multiplied by 120, or within brackets you can say 1 plus 20%, or 120%, whatever. That's going to be the PE ratio of Danton Company. Do we know their future earnings? Let's find it. Now it's given 116.3, but it upgraded its main manufacturing facility during the period. Expects to make annual pre-tax cost savings of 2.5, which means their profit will increase by 2.5 million. So now they have 116.3. That's also pre-tax. This 2.5 is also pre-tax. So pre-tax. This is going to be their future profit before tax multiplied by 1 minus 20%. 95.4. So the valuation, equity value is going to be PE multiplied by earnings per share. PE multiplied by earnings per share. That gives us V2, target company's pre-acquisition value. Done. Now we will go to the combined company. Combined company, here the PE ratio is to increase by 10% if the acquisition proceeds. Okay, so I can try the PE ratio. Kerin Company's PE ratio is 12.96. They say 10% higher, 14.26 will be the PE ratio of the combined company, which means next I have to find the future earnings. Future earnings. So last paragraph says there is some synergy, 15.2 revenue and cost synergy. Financial synergy is 5.3. So simple, we will add these profits. 381.9. Oh, we have it here. Wait, this is post-tax profit of Kerin plus this is post-tax profit of Danton plus take these synergies 15.2 and 5.3. But that is pre-tax. Make it post-tax. 1 minus 20%, 80%, shall I say? These two already I adjusted for tax. E3, E7 cells, this is already adjusted for tax. Synergy, I am adjusting for tax now. So only for that I put a bracket and multiplied by 80%. So equity value is going to be PE multiplied by earnings. So as I said, value generated by the acquisition, the V3, this is what I mark as V3 minus V1 and V2. V1 is here, V2 is here. First check how much we are getting. $506 million we are getting as value generated by the acquisition. Any mergers and acquisition question, we usually do this, which is required. Even here, advise the directors on suitable share for share exchange offer which meets the criteria. What is the criteria? Criteria is this. Here 30%. If the share for share offer scheme, 30% premium to Danton shareholders. Wait, we'll see. Danton's equity value, we found it this much, 1478.23. So with this we have to add the 30% and the shares that we offer should give them that total value. So share for share offer, value to be offered. How much value from the shares, how much value should be offered? Look here carefully. This is the equity value now. I will multiply that by 1 plus 30%. Why 1 plus 30%? Because they want 30% premium. 1921.7. Or you can find the premium separately and then add it for your clarity. Equity value or current equity value. I'm just copying the value from there. This is the current equity value and 30% premium. This into 30%. Total offer value. Right. Remember in the last slide I explained, from the total value created by the acquisition, you pay the premium, balance will increase the value of acquirers shareholders. Remember, the remaining, the balance, that will be added to the value of acquirers shareholders. So see, where are we here? Increase in Karen's equity value. You know, total value generated by the acquisition is this 506. Out of this 506 benefits, 443 is going to be given to the target company shareholders as premium. In the name of premium, it goes to them. Balance is the real benefit to these parent company shareholders. Check this working whether you understand up to this point. Parent company's shareholders, the benefit they get is $63.17 million in the share for share offer. Still, I did not answer the question because the question is design the share for share offer. So I need to tell how many shares each we have to offer. Okay, let's see. So let me take a table now. Look, Karen and Danton. So Karen's post acquisition value to the shareholders. Karen shareholders already they had a value of 3960. Now we say that will increase by 63. This is what their excuse me, Karen's shareholders, this is the value they are going to have now. Don't get confused. Simple C. Already we found the value, equity value. Then I found the value generated by the acquisition, which is 506. Sorry guys, some interruption with the software. Okay, coming back. So what I said is V1, V2 we found, combined companies value we found, value generated by the acquisition we found it so simply, V3 minus V1 and V2. Then we know how much a premium to be offered, 30%. So Danton company's equity is 1478, 30% of that will be the premium. Okay, so this is the premium we are offering. You know the premium from where it goes, from the value generated, premium has to be given. So out of 506, if 443 is given as premium, the balance 63 is the value to the parent company shareholders or acquiring company shareholders. That's what I did. Acquiring company shareholders already had this value. Now they are getting another 63 million. So this is the value. Danton companies Danton company shareholders, we are offering this value. So this is what they have to get. Right. This is the ratio of values they are going to have. This is the ratio of values. Let's get the ratio simplified. What we do, if I take this as 1, how much is this? Let's check this. Divided by, so that's 2.09. Let's bring it to 1 decimal. 2.1. So what this ratio tells, see, simply I divided 4023 by 1921. So what this ratio tells is the value division end of the day should be 1 to 2.1 value. In other words, if I speak in percentages, we can take the total value. Look at this percentage. If I say this divided by total value is going to be this. Because the overall company should have this total value. These two together must be the total value of the company. Because both of them are shareholders in the combined company. Of that, 4023 is going to be controlled by Kerin company's shareholders. Of the combined company's value, 1921 is going to be controlled by Danton company shareholders. So 67.67% is going to be controlled by Kerin company shareholders. Similarly, this divided by the total value, that is 32.33% is going to be controlled by Danton company shareholders. Still, I did not finish the question because I need to say how many shares we are going to offer. Okay. Kerin company shareholders, how many shares they have? Number of shares held. Their number of shares won't change, right? You know, when share for share offer happens, acquiring company shareholders will still continue with the same number of shares they had. Whereas the Danton company shareholders, if I show it in a diagram, right here, look here. This is the acquirer's shareholders. Let me say SHA. This is the target company. It has its shareholders, SHT. Now you have combined company. These guys will remain the shareholders. If we have given a cash offer, these people who shareholders of target company, they get the cash and they exit the scenario. They are out after that. Instead, what we do in this question, we are giving them shares in the combined company. So we issue some new shares for these guys. They will surrender these shares. The shares in target company, they are surrendering. They don't have it anymore. One option, we can pay them cash for that. The other option, we can give them shares on the combined company. So they will get some new shares from this target, from the combined company. So the point I wanted to highlight, SHA, acquiring company shareholders, number of shares they have, there is no change. There is no change. They will have the same number of shares. Okay. So here, number of shares held already. We found it. Where is that? Oh, we didn't find it. 175 was the value. Book value 0.5, 350 million shares. So value per share is going to be, this is the overall share values they have, equity value, their proportion. For that they have 350 million shares, 350, 11.49. Is 350 right? Let's go back and see. No. Ordinary shares, $375 million. 375. So redo the calculation. 375 divided by 0.5. So 750 is the number of shares. Value per share is going to be 5.36. Just a little bit inside there. Before the acquisition, their share price was 5.28. Remember? Here 5.28 I used. Now it is 5.36. There is a small increase in value for them. Right. Danton Company shareholders also will get the same shares. So 5.36 must be the share value for them as well. So if that is the share value, and if they want to have this much value altogether, what would be the number of shares? I am doing the reverse working. Look, this is the equity value. This is the value per share. Divide it, you get the number of shares. Am I right? Look at the process once again. This, how did I get? Danton's value plus 30% I added because they need 30% premium. Okay. How did I get this? The remaining value out of the value generated 506. 30% premium is 443. Once that is given 63 balance, add that with the parent company's current equity value, that gives you the parent company or the acquiring company's overall equity value. Right. Then this analysis, we did not use it so far. I'll just hide it for now. Okay. Then number of shares held. Simple. That's from the books. You find 750 for acquiring company. You can divide it. You get value per share. Use the same value per share here. Same value per share. And you can find number of shares held. How? This is going to be the equity value. This is the value per share. So number of shares must be this. Right. So actually you don't need that what I have hidden here. These figures were not needed. I just did some extra analysis there. Good. So what is going to be the offer? 358 million new shares must be offered. Okay. So Danton Company shareholders, number of shares currently held. How many shares do they have now? They have 0.25 ordinary shares, 35 million. 35 divided by 0.25, 140. So they have to give up these 140 million shares and they will get this many shares, 358. So number of new shares offered is this. I have to give this as a simplified ratio. Look, 140 given up, 358. I have to give it as a ratio. Let me divide it and see. .56. So how can I make it? This 358. Shall we make it 360 just to round it off? So let me say 140, 360. 358. I round it to make the ratio look good. Now 2 zeros I can leave. So leave. It becomes 14, 36. I'm simplifying the ratio, nothing much. I can divide these by 2, 7, 18. Do you understand? 14 divided by 2 is 7, 36 divided by 2 is 18. I think that's the most simplified ratio. So the offer is going to be share for share offer. Share for share offer is as follows. How? As follows. 18 new shares for 7 existing shares. That is the share for share offer. Right? That is a very nice question asking you to prepare or design the share for share offer. I have step by step shown you how to arrive at this figure. Once again, see, this is acquiring company's value. This is target company's value. Then I did the combined company's value, V3. V3 minus V1 and V2 gives you the value generated by acquisition. Then you find out how much is the premium value you are offering. From the value generation, subtract the premium, balance goes to the acquiring company's equity value. So acquiring company's new equity value should be this much. And for the target company shareholders, what we offer is this much. We know acquiring company's shares doesn't change. Those shareholders will continue to have the same number of shares. So now divide it and find out value per share, 5.36. Same shares these guys are also going to have. So 5.36. Divided, you can find how many shares must be newly written and given to them. 358 million. Now get a ratio. They have to surrender 140 million shares and they get 358 million shares. Find the ratio. So what I did, 358, I rounded to 360. So 0, 0, I divide by 10, 140, 36. I could divide that by 2, 7 and 18. So I say 18 new shares for 7 existing shares. Done. Now second part, which meets the criteria specified by Danton Company shareholders, and calculate the effect of cash and share for share offers on post acquisition wealth of both Kirin companies and Danton Company shareholders. Okay. So now let me put a heading here, impact on wealth. They are asking for both cash offer and share for share offer. Let me do share for share offer first, because just now I finished the analysis of that. Share for share offer. Kirin and Danton. Pre-acquisition equity value. We have it, we found it already, nothing much. Kirin's pre-acquisition equity value, we have it here. Equity value this. Danton's pre-acquisition value here. Then increase in value. We found that also. Here, increase in Kirin's equity value, 63. Danton, the premium we pay. Premium, this is the premium. So, increase in value as a percentage. %1.6%, very small percentage increase for them. These guys 30, we know already it's 30. This is share for share offer. Now let's check the cash offer. Or let's do some analysis. We did not analyze it yet. Amount to be paid. We know the number of shares of Danton. Danton's number of shares, they have 140 million shares are there. And what price are we offering? 13.1 if I remember correctly. Where was that? Here, cash offer of $13.1 per share. Amount to be paid. Right. So, how much premium is that? This minus the equity value. 1,478 is the current equity value, but you are paying 1,834. That gives them 355 premium. See, that premium is a little lower than the share premium. Why? Cash is certain. Immediately you are giving by cash, right? There is no uncertainty for them. Liquidity is high. Because of these reasons, cash offer will usually have lower premium than share for share offer. Find this percentage, premium percentage, or let's say Danton shareholders value increase. This is the premium amount they are getting. As a percentage of the original value, it is 24.07%. 24.0 or 24.1%. Okay. Then, how about the parent company, Kirin company? Increase in value for Kirin's shareholders. We know overall value generated is this. Of that amount, 355.77 is given as the premium, balance is there. So this is what Kerin's shareholders get due to the acquisition. See, I'm following this rule. Which rule? Value generated, premium paid, balance. Balance is for parent shareholders. Okay, increase in value. Give it as a percentage. As a percentage. Usually increase in value we discuss as a percentage. Otherwise it doesn't make sense. 150 as a percentage of original value. 4 percentage. 3.81 percentage. So they are asking both offers. This is for cash offer I have done. If the offer takes place, if the acquisition takes place, Danton shareholders they get 24.1 percentage gain. Kerin shareholders they get a 3.81 percentage gain. If the share for share offer takes place, Kerin shareholders get only 1.6 percentage gain. Danton shareholders get 30 percentage gain. Let's go back to the requirement. And then that's all in part B. 12 marks. Quite detailed calculation. 12 marks. It's worthy. Discuss the likely reaction of Kerin companies and Danton companies shareholders to the cash and share for share offers. Right. So I have to take cash offer and say what Kerin company shareholders will do, Danton shareholders will do. Similarly for share offer. One by one. Part C. Let's take cash offer. One thing I can say, cash offer, see both parties, compared to share offer, Kerin shareholders might prefer this because that gives a bigger gain, 1.6 percentage, 3.81 percentage. So let me say bigger gain to Kerin's shareholders. But when they get higher gain, there is a disadvantage. What? They have to give away the cash reserves. What is the disadvantage of that? Future dividends may be affected. Future investments may be affected. Cash reserves will decrease. May impact future investments and dividends. See, even this was there in the question. I read this in the question itself. So it's very easy for us to formulate this answer. Cash offer. This is for Kerin shareholders. What about these guys? Danton shareholders. Compared to share for share offer, this gives lower gain, 24.1. So purely looking at a gain perspective, this might be lower for them. However, considering the uncertainty, considering the future expectations and all that, considering the liquidity factors, cash offer might be preferable. They might be happy to accept this. So let's say Danton shareholders gain is low in the sense what? Lower than the other offer, but less, or let's say more certain and liquid. Also in cash offer, there is one more disadvantage for these guys, Kerin's company. The Danton company's founders, they still want to keep them in the board. But if you have given the cash offer, they are not shareholders anymore. They just become appointed managers, appointed directors. Then the agency costs might arise. What is it? They might take decisions which are not in the best interest of the shareholders. That also you have to consider. If you really want to keep them in, giving them cash offer and removing them and then appointing them as director might have adverse impacts. So let's say, simply I'm saying agency issues may arise. But you have to elaborate this. I'm just giving the short form answers here. Cash offer. In the share for share offer, already I have discussed that. So when you're writing the answer, just compare and write it. The share for share offer, lower gain. To whom? Karen shareholders. Lower gain, but keep the reserves. Your cash reserves are unaffected. No agency issues. Why no agency issues? The Danton shareholders will still remain as shareholders and they will be sitting on the board. So they won't have any agency issues. That's for Karen. Danton. Higher gain, but exposed to the future uncertainties, right? Right, so that is what the answer for part C would be, 4 marks. So cash offer 2 marks, share for share offer 2 marks. Clear? Make sure you don't write bullet points, you write proper paragraphs explaining each clearly. Doesn't matter the length of the answer. Some of the students think length of the answer is connected to the marks. Not at all. Whether you have clearly explained your point. That's what they see. So how many points are there? Whether each point has been clearly presented, logically presented, that's it. That gives you the marks. Clear? Cool. So that is one question one of the student has asked me to clarify. I have done it here. If you guys also have any other doubts, please feel free to comment it, mentioning the question name and number. Number might be different from book to book. At least mention the question name. I will search and find it. Then I will answer those questions for you. In the meantime, if you are benefiting from my videos, please give me your feedbacks and share these videos with your friends. Ask them to subscribe. Encourage me to do this more. I'll be happy to do. Thank you.